Welcome to DeFi by Design, where we talk all things blockchain and cryptocurrency while striving to educate, empower, and enrich.
It's your boy Andy, and welcome back to the DeFi Slate YouTube channel. Smash the like button on this video, that really helps us out, and sit back and enjoy the content. Thank you very much.
What's going on, guys? Welcome back to the DeFi by Design podcast, episode 80 here today. Big milestone for us, 20 more to get to 100. We're grinding through these. And today, excited to talk about what's coming up with Ethereum, and the merge is coming. I think we just saw the announcement. There's like 3 or 4 more testnet merges happening. And then we have got to be announced, but middle of September is the actual merge date, or the expected merge date, which based on the Ethereum community might not happen. But we're optimistic and excited today to be talking with a protocol and a developer, Filipe, who has been building on Ankr and building out their liquid staking. We're going to discuss what the merge means for Ethereum, what liquid staking means for DeFi yields, how you guys can get better yields with some of these liquid staking tokens. You're going to talk about kind of what the post-merge world looks like, some evolutions of yield farming, and whatever else we are going to cover, we will talk about. So excited today, of course. Yeah, today we're going to be talking about the Ethereum merge and the post-merge world, and anything else that Filipe has in store for us. So good morning, Filipe. How are you?
Hey, good morning. I'm good, and you? Thank you for hosting me.
Yes, sir. Yes, sir. So do you think the merge is going to happen on schedule? Well, what do you think there?
Well, I think there is often something unexpected happening, and some delays can occur. But yeah, I think we should focus on is the milestone is approaching, and yeah, what it means for the community, post merge, what's going to happen. And if there is eventually some delay, I think it's not necessarily a big deal, but it will be nice to get prepared about what's coming.
Yeah, definitely. This has been like the event that all the DeFi people have been excited about for forever now. It's like been forever on the horizon. It feels closer than ever, but also like sentiment around Ethereum and DeFi and NFTs even and DAOs is like all-time lows. Like I mean, like sentiment is just in the gutter when like one of the biggest events ever is coming. I mean, it's supposed to be like basically 2 months from now. It's so interesting to see how like the crowd and the wisdom of the crowd is sometimes so opposite of what is kind of coming in the future. And it's all about the prices, and of course, but yeah, we're definitely excited about the merge. Would love to kind of hear about what your backstory is, how you got involved with Ankr and liquid staking. What that even is. And yeah.
Yeah, sure. So actually, I have a financial background. I used to be a wealth manager for 8 years. And yeah, was investing in crypto for the last 5 years, and I joined Ankr a bit more than a year ago. And yeah, actually, when I started to dig into DeFi and trying to understand it, I got really hooked into liquid staking. So at the time, I got really impressed by Ankr. It was in December 2020. They were the first ones to create ETH liquid staking. At the time, the main reason it was to provide liquidity for stake ETH, right, until the merge happens. And when I joined, I think it was about 6 months later, my task was to expand the concept of liquid staking to other chains where you can actually unstake. So it kind of forced me to kind of understand, okay, what's going to happen post-merge? So what is the purpose then of liquid staking? Is it going to be just like irrelevant, or is there still something that is useful for liquid staking? So that's where I started to expand that narrative that liquid staking is like solving the capital inefficiency of proof of stake. It's enabling DeFi composability on top of staked ETH, but also then staked, Avalanche, staked BNB, staked Matic, and so on and so forth. And ultimately can also become a liquid infrastructure for integrators such as BlockFi, unfortunately Celsius. And obviously for them, it's a way to more easily offer that kind of staking infrastructure service in a much easier way by just delegating all the operational aspects to liquid staking providers, for instance.
Yeah, did the I mean the concept of liquid staking is basically like you are able to run you're able to be part of a validator node which secures these proof of stake chains without having to do all of the technology and all of the coding and the brunt work effectively, which really takes out a huge step for a lot of people. I've heard on Bankless and through other kind of threads about this idea of a risk-free yield on ETH or the risk-adjusted yield on ETH post-merge. Do you have any thoughts on what this means kind of for ETH as an asset? What is this concept of this like risk-adjusted yield or this like kind of like, I guess it could be like a benchmark yield for crypto in terms of all stakeable assets, ETH being kind of like the highest market cap. What are your thoughts on this concept and like what does this mean?
Yeah, that's a good point. So I think you have to see every chain like a crypto economy in itself, and then you have the apps that really, represent that crypto economy. And for every economy, then you have some reference rates, right? And in the case of ETH, it's ETH staking rewards. In case of Avalanche, it's Avalanche staking. But there is still, I will say that using the term risk-free, right, is really like the analogy with TradFi, where obviously governments and the central bank, they can just print money. In our case here, there is still like some risks involved, right? Where obviously being a validator, delegate staking, let's say on Polygon, or using liquid staking have different type of risks. With liquid staking, you still have the smart contract risk. With delegate staking, you don't have that smart contract risk anymore. And if you're using a custodian, well, you always also have, some problems with the keys. So there is still a few risks involved. And however, then we have also a competing, benchmark yield as well. If you look at Aave, lending interest on ETH or lending interest on Matic, on Aave as well on Polygon network, you will notice that it's often, lower than the staking rewards. Why? Because there is even lower liquidity risk, right, for lending interest, because you cannot, when you unstake Matic, for example, you can do it, actually when you withdraw funds from Aave, you can do it, pretty much any time unless the utilization rate is at 100%. With liquid staking, you still have, the ability to unstake, so redeem it back to, let's say, Ankr, for example, but then you have an unbundling period. So that part of staking, unstaking with liquid staking, you need to see it a little bit like the primary market, and unstaking can take a few days, which is dependent on the unbundling period. And then you have the secondary market, which is trading liquid staking tokens on the DEX. And here it might have a different price depending on the liquidity on a DEX, right? So I think that there is really that competition between lending interest and staking rewards. And then it's kind of hard to define, with a clear cut, staking is the benchmark yield or lending interest is the benchmark yield. I personally believe more that there should be a convergence of the lending interest towards the staking rewards, as then you might have really some very interesting low risk strategies where you could just potentially stake, borrow, let's say ETH at a lower rate than stake with liquid staking, and you take that leverage. The big issue is that unfortunately it seems that some providers did that, but the issue is that ETH liquid staking is not a redeemable token yet. If ETH liquid staking was a redeemable token like Matic, Avalanche, BNB liquid staking are, well then that kind of margin lending and everything and liquidations will probably not happen because they will have the options to just unstake, right? So I think here it's a very big difference. But yeah, Ethereum with the post merge, I think Ethereum will become actually less risky. So that will be very interesting.
The problem right now, or the situation right now, is that, like the staked ETH kind of 𝗍𝗍 or just basically not being one-to-one. There's been a lot of talk of it being a 𝗍𝗍, but it's not necessarily a 𝗍𝗍. As you're saying, it's just more of it's not redeemable right now. But with the other assets like BNB and Matic and AVAX that are redeemable, we're able to see some interesting kind of lending and borrowing strategies come to the market because of these. Do you ever see a world where those staked assets like Ankr staked BNB or AVAX or Lido staked, Polygon or anything, or do you see a world where those are like the base layer, like the base kind of layer of settlement, where the BNB token almost becomes just a non-factor compared to holding staked BNB or Matic? So where there is enough liquidity on decentralized exchanges and other areas to trade where, basically those assets become like they almost overtake their non-productive forms, if you will.
Yeah, I mean, I think so. I think, but I just believe that there will be obviously several providers with two main sources of, let's say, low risk rewards, which is lending interest and staking rewards. Having lending interest that is a bit less risky, so the rewards should be slightly lower. And for staking rewards where it's a little bit, it will be slightly higher probably the staking rewards, but still with that unbundling period, that provides a little bit higher illiquidity risk for that option. And I personally believe integrators that will probably, in their own way, diversify, across all these baskets, because obviously, if you're using like a small lending platform and you're lending to Aave, in terms of liquidity risk, it's not necessarily the same, right? Maybe you go to a smaller peer-to-peer lending platform, there is only 10 million liquidity. Obviously, if you provide 2 million in there, you represent already 20% of the pool, right? So if the utilization rate is at 85%, yeah, you cannot remove instantly your funds. That's kind of problematic. So diversification is key, but that also then adds some level of complexity potentially for integrators that will have to manage these strategies. And obviously, like investment funds in TradFi, every fund manager has a different risk strategy, and they're managing things in a different way. I think with the using blockchain, as a financial infrastructure, I think really the improvements that we should have is really to offer that transparency, meaning that if, for example, BlockFi is offering a yield strategy, because this is on-chain, it will be really appreciated to have real-time, full transparency about the state of that strategy, what is really going on. I know that some integrators issue like monthly reports, like funds, but I think we really have the room to really offer that improvement and offer that real-time transparency, which will also be important to provide more trust to the system, since now, given the latest events, trust has been, a bit broken for certain providers, CeFi providers. So I really hope to see that evolvement in the ecosystem.
Yeah, that's definitely a big one. I agree. It's kind of the whole point of all of this, really, is to make that kind of transparent, trustless, thriving system without being behind closed doors, if you will. Now, kind of switching gears back to the merge. Before Robbie dropped off, he shot me a quick message, and he was curious, and I am as well. Obviously, you don't have a crystal ball here, but we're curious what you think about a potential fork happening due to the merge. What the chances are of that. Why this would happen. And what it could look like.
I mean, yeah, there is always like a chance that there is a fork, like Ethereum Classic, so a few years ago. I mean, I think I think like all the effort that has been put to the to make the transition to the merge, I personally believe that most of the people will stick with the main plan, and if there is any part of the community that is willing to take a different direction, for it might eventually happen. But I personally believe that the merge is really very much anticipated. I think, to be honest, that there is more and more new projects and developers that are just keeping Ethereum completely due to the high gas fees, and they're going straight to Polygon or Avalanche or BNB chain. And yeah, I really hope that this is coming soon, so that there is more builders and more innovation happening on Ethereum again, because it makes already a few months, right? That's every new project that you see, they're mostly not starting on Ethereum, but they're starting elsewhere.
Yeah, yeah, and I tend to agree. I think there's been a lot of effort and time and thought behind going into towards proof of stake. And I mean, obviously, the miners might have a different thought process, but yeah, a fork seems to be kind of foolish. Like if you think about it from the miner's perspective, I mean, if you've got all this equipment and assumedly a nice stash of ETH, you could basically either start to mine other chains or sell all your ETH, stake it, and just basically get that yield without having to even own the machines. So there's or do a mix of kind of both. So yeah, I mean the fork would be a wild run, but I'm not sure that we see it either. But obviously it's in the cards. Kind of switching back to liquid staking now. So in a post merge world, are you of the belief that we will see some higher lending and borrowing rates on liquid staked ETH, lower rates? Kind of what will be some of the driving factors for the desire to lend and borrow these staked ETH, and what are you expecting there as far as the yields come?
So I think post-merge, so when things stabilize, a few months after, I personally believe that logically the risk of staking ETH is going to be lower because there will be, certainty about the unbundling period, and it's no longer being like unknown. So I think this is already a major risk difference when compared to other chains. And currently Ethereum is lagging behind in terms of staking ratio. So there is only about 10% of ETH being staked. For Polygon, I think it's about 33%. For Avalanche, it's about 60%. For BNB, it's about 80%, right? So there is obviously like a lot of room for improvement. And if you think about the staking ratio, it really means that if it's staked, those tokens are like out of circulation. So it's decreasing also the circulating supply to give a reason for people to just stake, contribute for the security. So if the staking APR should be lower than now, because there is less risk simply, right? At the same time, we know that the block subsidy and the revenue tip, to validators is also, going to be now parts of the revenue stream for stakers. So the amount of revenues are also going to increase. So then you know that the denominator of that equation, right, which is revenue generated by, the validators divided by the staked amount, gives you the staking APY. So that means that the amount of ETH staked needs to increase to basically match that equation, right? And I think that we will see that convergence, of the staking ratio of ETH going closer to its peers.
Yeah, and I mean as ETH price fluctuates up and down in dollar value, the dollar value of the yield obviously changes up and down, but the percentage remains a factor of as you're saying, the amount of ETH staked and compared to the overall just like the tip and the subsidy and the amount of ETH staked, and just kind of makes sense that the yield would technically be lower in the future based on less risk. But I've been seeing things that are saying that the expected yield is 7% or something, or 5, 7, 8% on ETH. But right now it's at 4%.
It might happen. It might happen like right after the merge, right? Just because you have that increased amount of revenues coming. So this is something that might eventually happen. But if right now there is people that are happy to stake ETH for
Yeah.
4%, if you project yourself like in 6 months when everything transition already and the market stabilized, well, if there is less staking risk to stake ETH now and people do it for 4%, maybe they will still do it for 3% eventually, right? So this is something that I personally believe will likely happen. But I don't disagree with the forecasts mentioning 7% short term. That can perfectly
Yeah.
happen.
Yeah, I mean, it seems too easy if it would be that high for so long. There'd be some extraneous risks, and the idea is that staking ETH shouldn't be that much more risky than just holding an ETH position itself. So really, there wouldn't be that much of a payout. Yeah, I'm curious what you guys are working towards at Ankr. With this launch coming of the merge, kind of what are you guys, what's on your agenda here now?
Yeah, so we actually announced this week our collaboration with the SSV network. So for those that are not familiar with SSV, I mean, basically, Ethereum is going to be proof of stake. Most other chains are delegated proof of stake. So basically, staking with other chains will still be actually easier because you just delegate stake to a validator for Ethereum. It will still be relatively complex because you need to have 32 ETH, right? You need to be a validator. You cannot just delegate stake like that. So SSV is basically working for already more than a year on a trustless system where you can basically delegate the validation keys to SSV nodes. And then you have those node operators that are basically, doing the job of being a validator in a trustless way. So we do have like a very similar system because we actually have 208 node providers in our ecosystem, which is like semi-permissionless. Currently, we basically stopped accepting no node providers because we feel like we have enough. And accepting more means that you're diluting, the APY of your, let's say, power users, right, that have been like node providers since day one. So with SSV is really creating that open market, meaning that we're going to launch a second version of ETH liquid staking using, that SSV network infrastructure, offering a fully trustless alternative for ETH liquid staking, right? Obviously, there is, it's very new, it's still on testnet, so there is some let's say execution risk or a technological risk. That's obviously we believe SSV is going to be in line with the highest security standards. So we're going to have for some time these two versions where you have the initial system that is not fully trustless because you need to trust Ankr for that system, and the other alternative that will be trustless. So that's something that we believe will be really interesting. And then having they already have a lot of node providers that are participating as well in the SSV network. So we believe it will be really interesting for supporting the ecosystem and recognizing when there is other teams working very heavily on something very specific. We're glad to partner with them, since as a Web3 infrastructure provider, we're not just doing liquid staking, so we have also other product lines, and we cannot focus. We cannot have the same amount of focus on every single product line than competitors and successful teams that just do that. Right?
Yeah, interesting. And we kind of think that the liquid staking market will probably just continue to grow over the next couple of years. I mean, especially when you like introduce this to like traditional finance, you worked in that space for some time. Like, do you think that those types of entities would be interested in something like a staked ETH product? Like, how would you go about explaining that to them? Like, why would they, why would an institution want to look at something like this?
Yeah, I mean, there is many institutional investors interested, but currently, because, having 32 ETH is not really an issue for them. And because they have so much liquidity that using DeFi, it doesn't necessarily offer the amount of liquidity that they need, right? So they're just delegate staking or being a validator, that's where actually most of the staked assets for most chains come from, right? It's mostly institutional investors already. Offering liquid staking offers really that additional layer of risk, which is the smart contract risk, and they need to rely on the threshold signature mechanism to hold the smart contract keys. And obviously, we cannot give it to them because it's like we need to preserve the fungibility of the product, right? So that's where I personally believe that liquid staking will be democratized in the way that we might end up offering like white label liquid staking to institutional investors, and basically offering white label in like ETH liquid staking, for example, to, let's say, we're not in contact with them, it's just like a random example, let's say Goldman Sachs. So, well, then basically we're giving them the keys of the smart contract, but they're the ones using that. If anyone wants to delegate stake kind of, or using their version of liquid staking, no problem, they can do it. And if we have enough demand, we might even potentially consider not only delegating the validation keys to node providers, but we might eventually also delegate stakes simply with the white label solutions of our institutional clients to diversify, being kind of a wrapper eventually. So that's the kind of thing that we're thinking about. But I personally believe attracting more volume from institutional investors. So either they will trust, that trustless system similar to SSV, or they will like to have their version, of their own. Obviously, that will be very, very big institutions potentially going that route. But then there is still, family offices and, players in between that can, use one version or the other.
Yeah. I'm curious if you think that aside from the liquidity issue, which is obviously makes sense, just based on size of, transactions for these institutions to make it worthwhile. Like, I'm curious if you think they have questions about kind of like the inflation or the inflationary mechanism that is staking, like that these new tokens are basically created, and on something like Ethereum, like there's no cap necessarily. Obviously, we've got EIP 1559, so we can dive into that as well. But I'm curious, like, if you fielded any questions, about like how does this end, or like, where does this stop, with regards to the inflation.
Well, I mean, for Ethereum rates, obviously, like staking is offering that feeling of stable rewards, right? That are very like they're not really volatile, just because it's based on block subsidy, right? And then with the gas fees that they collect, then they're planning to be burned. So that's then net, there is an inflation that will likely be lower. At the same time, you have other chains like BNB chain, where the gas fees are going directly to the validators. So the volatility of the staking rewards is actually, bigger. I remember like 8 months ago, it was still like 25% staking rewards on BNB, and now it's only about 5%, right? Just because there is less transactions, less gas fees. And that's really, really interesting, because somehow the money velocity of BNB is kind of being captured into the staking rewards, right? So that's something that is very interesting, and an alternative model than traditional finance and central banks and everything. So I don't think it's an issue as long as there is gas fees that are in a similar situation than the amount of tokens being minted to incentivize the validators, right? So I'm not sure about, for example, if you check Phantom, if they end up having not many gas fees and transactions and no burn at all, and they're just minting more and more and more, that can eventually be like an issue. But the gas fees is also a reflection of more users using your network and creating network of adoption, right? So yeah, creating inflation forever without growth in gas fees or even just users using your platform, which is the same ultimately, that might be, eventually an issue. But I think everyone is kind of, capable to create their own opinion about, do I want to have exposure like on some tier 2 chain, or do you want to have exposure on a tier 1 chain where you believe there will be more and more users? Because ultimately, the staking rewards is not the main attractive point, right? You need to believe on the chain first to have Ethereum or Polygon or BNB, and then the fact to stake is a secondary decision. Like you can do it and bear some smart contract risk, some liquidity risk, or you can just not do it, right? But the main decision is still like, do you believe in the future of that chain? Because most of your gains are going to come from the price appreciation of the token, not from the staking rewards, obviously.
Staking rewards is kind of just like a cherry on top if you're a long-term, convicted believer of that particular chain. And I don't think that Ethereum will face the issue of lack of growth, because I think we'll see layer 2s really massively grow on their adoption, and those will basically just pump fees pretty heavily to the main chain and to the stakers. And then of course you've got the EIP 1559 in place, which kind of takes away some of that inflation. So I mean, really, pitching the idea to an institution of liquid staking on Ethereum, I mean, it's something that they've probably never even seen or heard of before in terms of a financial product, because of the technology of the blockchain, but also just the type of asset that Ethereum is. It's kind of like there's not really anything else in the world like it, which is quite exciting, most definitely. I want to kind of switch gears to the staked ETH pre-merge event now. We kind of are seeing it, I think, on Lido. It's trading still just under 1-to-1. It's recovered a bit. Is this just a risk premium that people are paying, that it's worth a little bit less because of the assumed risk of this? What are your thoughts on why that staked ETH is still off of 1-to-1 and it being non-redeemable? Do you have any predictions for potentially what might happen to these non-redeemable staked ETH assets, whether it's Ankr or Lido or anyone else, leading up to the merge? Do you think that they're going to kind of come closer to parity, go further apart? Do you have any kind of speculations there?
Yeah, I think it's very interesting that, because, for example, STETH from Lido was trading at fair price for such a long time, and it gave that, illusion of price stability. I think most market participants perceived it almost like some sort of stablecoin that just earns rewards on top. And they kind of forgot, right, that it's not a redeemable token. So most of the liquidity risk is dependent on the size of the liquidity pools. And obviously they did a phenomenal job to have very large liquidity pools on Curve, for example, to accommodate, right, all these new participants. The thing is, the bigger is the liquidity, the bigger participants it brings. And then if you have, but then they're not necessarily aware that, imagine they have 300 million liquidity, and you have one institutional investor that is okay, I have 5% of the total liquidity of Curve, that's fine, but maybe there is 20 other people that are in the same situation, right? So the thing is, because the supply of the liquid staking token is not elastic, because it's not redeemable, then if at some point people want to just, sell their STEs, their staked ETH, they're creating basically selling pressure. And here what just happened is like the liquidity pool was, you know, not big enough to accommodate all the selling pressure, because they got in, some of them because of the farming rewards as well. Otherwise it's not really interesting to be a liquidity provider. And yeah, that's basically, it shows that over the last few months we just have more selling pressure from just staked ETH, and the price stability might eventually come back when people are kind of willing to move back into, you know, Ethereum. If you think about it, the staking rewards, how does it change for chains in general? It changes because there is like the staking ratio is increasing or the staking ratio is decreasing, right? So the more staked ETH there is, the lower the APR. And technically, if we were post-merge, the less staked, if there is less ETH being staked, then the rewards should go up. But because you cannot unstake, the only way to reflect that kind of pullback is through now the price of ETH liquid staking and its you know, discount. So you can actually calculate what I personally call like the yield to redemption ratio, which is, you know, assume that you can have ETH liquid staking, let's say a 2% discount, and then the rewards are at 4. So then you could assume that if when you can redeem, you get basically in 1 year like 6% instead of 4, because you bought it at the discount. So that might also mean that actually the staking rewards now, if the market was fully open and we could just unstake, maybe it means that it should be 6% now, the rewards on ETH, and not 4%, right? But because, yeah, we're still in transition and the merge, it didn't happen yet, yeah, you cannot really let the market kind of really reflect what is the true rate. So yeah, that's basically my opinion on the topic, but I'm not worried about the discount in itself. Yeah, so I think whenever it happens, the merge and the withdrawal, which happens actually after the merge, well, then you can just unstake and basically lock in the difference.
Yeah, and as you were
The
saying
profit,
on
yeah.
Ankr as well, there's an opportunity for some arbitrage between the two different types of staked assets. You know, when you bridge them over from each chain, you know, what is that? Why is that mechanism there for you guys? What does that do for the?
Yeah, sure. So yeah, sure. So, I mean, there is obviously, you know, Ethereum, not only on Ethereum chain, but also on BNB chain, on Polygon, and so on and so forth, Arbitrum, obviously. So we personally believe that liquid staking should be like a multi-chain experience, and we should not restrict people to have ETH liquid staking just on Ethereum. We personally believe that, you know, it should be accessible from any chain ultimately. So that's why we created our own bridge to be able to offer that kind of multi-chain staking experience. And we're continuing to make that product evolve to offer ultimately a cross-chain staking experience where ideally we would love to see people, you know, let's say on BNB chain and they have ETH and they will just stake their ETH on BNB chain on Ankr and they get ETH liquid staking. Right, so that's ultimately, we believe, you know, the like a true cross-chain staking experience that will be very beneficial. And then obviously, you know, if you can borrow ETH more cheaply on, you know, Venus on BNB chain than on Aave on Ethereum, well, you know, we want people to be able to exploit, you know, that kind of, you know, market opportunities and exploit, you know, differences from different chains.
Yeah, I mean, there's all these different arbitrage opportunities because of these bridges on different chains, which is really interesting that we're seeing that, because this is kind of new for everybody. The multi-chain world, the bridging and the different assets on different chains and the wrappers and all of this. But yeah, it provides these kind of like understanding the risk opportunity and then being able to act on it to basically make you know, some sort of educated kind of gamble on a play like this. And yeah, it comes, so it's so funny. So ETH is so different than these other stakeable assets right now, because it's just not, you just can't get the instant redemption on it, because the merge hasn't happened yet. So it kind of layers in all these different complications that, you know, are not present with these other assets. So definitely excited for a more fluid world where we see ETH being able to just be instantly taken out of the smart contract, the staking contract, and just used in DeFi, or be able to pull out to your bank account to cash or whatever it is. Yeah.
To be honest, it's also one of the reasons why we kind of decided to focus more on BNB liquid staking and Matic liquid staking, and basically let our ETH liquid staking now honestly it's traded at the discount of about 12% if I'm not mistaken, and it's been like that actually for several months. And for us, the only alternative to fix that, it was like, okay, we can add farming rewards to liquidity pools so that it becomes bigger. And we're like, but why should we add farming rewards if the discount is an incentive in itself already, to just have it? So it didn't really make sense to, try to compete with Lido on that front. And we believe that there was really a much bigger opportunity to explore with other chains what's going to become ETH liquid staking post-merge, right? Okay, what if you now created isolated lending for liquid staking? What if you create an interest rates model for on the lending platform that is actually indexed with the staking rewards to optimize the lending interest? And exploring and educating partners on other chains about that, we believe that it was like most suitable strategy for the current moment, so that then we can basically export all that know-how back to Ethereum when Ethereum is finally ready to be fully redeemable, and then we can have those use cases as well for Ethereum.
Binance Chain had so much action too in DeFi. There's so many users, so many gas fees happening. Even though the fees are smaller than Ethereum's, there was still just so much activity. So definitely can understand where that where that decision comes from. And Polygon as well. Polygon just somehow seems to just secure every massive partnership. Like they just recently got one with Disney or something like that. It's just, they have an insane kind of business team, just absolutely growing that. So I expect both to grow as well. As we kind of wrap up here, I'm curious, how our community can get involved with liquid staking, what to check out, how to be active, how to help out, anything on that front.
Yeah, sure. I mean, you can just go on Ankr.com on staking. So there you can see our staking dashboard. So you can see all the liquid staking available. Next week, we shall have an upgrade of our DeFi dashboard on Ankr staking, where you will be able to see all the use cases possible for liquid staking from Ankr on different chains. It's a multi-chain experience, right? After you staked, if you see the dashboard, you will see your personal positions. We're also upgrading that to really allow you to basically see your yield, like your annual expected yield, and kind of, making users more sensitive about how much it means in US dollars, right? Because people tend to put that as a second priority, earning yield on ETH and BNB, because that's not the main reason why they have it. But, when you figure it out that, oh, actually, I can earn 20,000 more per year if I stake my assets, maybe you realize that, why should you leave money on the table, kind of, and maybe it makes sense to participate into staking as well.
Thank you so much for coming on. It's been a pleasure, Filipe. And yeah, man, excited to have the merge go through and see what happens.
Thank you. My pleasure.
Are you going to be in Paris? Did I ask you that? No, you said some of the team is going to be. So I'm going to have to link up with them. And excited to talk about the merge with people in Paris. And apparently ETH Berlin is going to happen around the time of the merge. So that'll be interesting if that goes through. But thank you again for coming on, Filipe.